defining what or telling what venture capital is about. It's simply the kind of funding that investors provide to startup companies and SMEs that have growth potential.
Growth potential.
Growth potential. And that is very, very
we'll come back to that one, growth
critical. So startups and small and medium enterprises that have growth potential. And so it's like catch them young, identify the companies that have growth potential, give them the financial support that they need, let them grow to become big players.
Okay, so you mentioned giving them the financial support, and again, I would dwell on it a bit, but in due course. But for now, I'd like to know the difference between, the banking sector, the financial sector, and the support they give to people anyway, because individuals who want to start their own businesses sometimes apply to the banks for financial support. What difference is there between those banks, those financial services, and venture capital?
Okay. Those banks, we call them the traditional source of funding. I mean, the banks and then the microfinances and all those things. And anytime people think about starting businesses, that is what they think of. But let me explain it this way. It's like you having a 1-month-old baby, and then you start giving him or her fufu.
Like Leo will do when he grows. Well, you lost fufu. You are killing a baby. Don't do a business. Don't
so if you are starting a business, I mean, the banks is not the right place to go.
So let's get that. If you're starting a business, the bank is not the right place. They're not saying don't go there, but it is not the right place to go. The right place to go to is
the venture capital.
If you're starting a business, the right place to go to is not the bank, or go straight to venture capital. Please go on.
Okay. And you asked about the differences. The first difference is that the traditional source of finance, that is a bank, they give loans. Venture capitalists usually gives equity.
Okay.
So let me explain it with numbers. Assuming you go to a bank, you need 100,000 to support your business. They will give you a loan. It comes with an interest. End of story.
They might even ask for collateral and stuff like that.
Yes, those things will come up. But then you go to a venture capitalist. It's okay. I'm starting a business. We mentioned startups. I'm starting a business. I need, let's say, 100,000 to start the business. The business promoter, I have 50,000. I need additional 50,000. What the venture capitalist will do is that he will give you the 50,000. So together, he becomes an equity shareholder or a shareholder of your business. So you owe 50% of that business. He owes 50% of that business. He will provide you with technical assistance. Banks usually, they give you money, end of story. They expect the money. But a venture capitalist will help you to grow the business, create value. He is not a permanent shareholder, and that is what sometimes our Ghanaian businesses are scared of. I want this business to be mine, so I only need a loan and not an equity or shares. But then when a venture capitalist comes in, he's more of a temporary shareholder.
Let's say partner. I think partner would be more exactly for people.
Okay. Then let's say in 2 years, 5 years time, the business has grown to the level that you are capable of managing the finances yourself. You have enough money, you've generated enough money, and you want the venture capitalist to exit. What he does is that you bring an independent person. He will value the business. When you started, you brought 50,000, he brought 50,000. You bring an independent person, he will value the business. Let's assume now the business is worth 200,000 after 2 years. Because he has 50%, you have 50%. You give him 100,000, he goes away, the business becomes yours forever and ever, and he will not show up again. And that is the biggest difference, because when you go to the bank, they don't talk about equity, but they give you loan. The other difference is that we call venture capital money patient money, because he can even give you up to 10 years without you returning money to him, but all that you are doing is creating value together. You can grow the business from 100,000 to millions of cedis before you decide to arrange and then part company.
How